Today on Resource Talks, Ian Cassel is going to tell me when to buy, what to hold, and when to sell during what seems to be finally a bull market in metals and mining. And hopefully after that, Ian will also get to talk about how you tell the good from the bad operators in an upward market, insider buying, marketing, and a bunch of other things in between. But just briefly for people watching or listening, if you want a summary of this conversation and all the other interviews that we do on Resource Talks, go to resourcetalks.com. There's a free newsletter. It goes out once a week with a bullet point summary of all the conversations from the week before. No longer of an intro needed here. Ian's been on the channel multiple times before, so shut up already. And Ian, thank you so much for being here today.
Hey, thanks for having me on. I really enjoyed doing this with you. You're one of my favorite interviewers, so it's an honor.
Well, thank you so much for saying that. I'm going to listen to all the other interviews to see if you tell that to all the people you speak to before I feel special. But I really appreciate it. And you know, our last conversation was it was eye-opening for me, and it generated some very good feedback and as well as some disagreements. And I think this one will generate more of all the above because again, metals and mining are in a bull market, and I don't really know how to deal with it. And I feel like I'm using these conversations as a bit of a therapy session too. So that's cool. It's also fitting one of your recent articles. You simply titled it FOMO, so fear of missing out, where a quote at the beginning kind of hit home for me, and where you say, and I quote, "We watch stocks we don't own outperform what we do own, and it makes us do stupid things," unquote. I don't really need help with the latter. I do stupid things in bear markets too, to be fair. But then somewhat later on in the article, you continuing on with another quote, and you say, "You wonder if you should loosen your standards to let the next one into your portfolio," unquote. And that's really what I'm having a hard time with. So a very broad question here at the beginning, but how do you deal with all that? How do you deal with bull markets in the first place?
Well, I think it's the same as bull markets are the same as bear markets with that, where you just need to make sure that you're disconnecting yourself from crowd behavior. And the first part of that is doing your own independent work into whatever you're investing in. And, if you can do that, you can kind of disconnect from that crowd behavior. I think in bull markets, even when you're in companies that are doing well, it's important to not let other bullish people make you more bullish, and, to really kind of keep your expectations grounded in reality. I think in resources in particular, it's easy to get caught up in, if it's a gold stock or something like that, it's easy to always say, if gold goes to 3,500, which is close to, or 4,000 or 5,000 or 10,000, company will be earning X, Y, and Z, and it's always cheap because you're always pushing that underlying price up, and I think that's where resource investors can get in trouble. Using gold as an example, I have some exposure to gold in my portfolio. I don't think about $4,000 gold or $5,000 gold. I think about $2,700 gold, because, I think it'd be very healthy if gold pulled back. I mean, it's gone, from what, 2,500 to 3,400 in 18 months. I think it'd be very healthy for it to pull back to 2,700, and so that's kind of a reality and a benchmark or base price that I use to underwrite any new investment thesis in gold in particular, or anything I own currently, is always at a lower price. Can I still double my money in 3 years, or, a 25% CAGR, is what I'm thinking about. And so I think always anchoring yourself to reality and not buying into the crowd's behavior and human nature to always want to underline a higher commodity price. I think that's important as a resource investor. And listen, resource investing it's a polarizing space. I mean, when you think about it, and rightly so, any cyclical industry, where you have to wait 10 to 15 years sometimes to be right. You're trying to be right 3 years out of 15, catching those big hard moves. It just introduces kind of loud polarizing advocates, when you have to wait 10 years to be right. And so it just underlines again, it's important to just live in reality, control yourself, control your emotions, and and always have your expectations below the current commodity price level, not above.
It really is tough when you start looking at what other people are doing, though, because and there's I don't know if you've seen this experiment, but there's like a Dutch scientist that researches monkeys, and then he gives so the monkeys have like a little stone in their cage, and then he puts his hand out, the monkey puts in a stone, and in return they get some food back. So they're paying for the food essentially with these stones, and the monkey in the left cage gets a cucumber and it eats it kind of happily. But then the second it sees that the monkey next to it gets a grape for the same stone, it starts kind of freaking out. And then the researcher tries to give it, cucumber again, but then the monkey, takes it, throws it away, and kind of tries to break out of the cage to get its stone back, to get its payment back. And that's really what more or less seems to be had. It sounds funny, right? Because in the first place, it was happy with what it had received for its payment, and then the moment it saw that someone else is getting something better and tastier, like the grape, it started getting pissed off. And I feel like what I'm saying here is basically that I'm a monkey, because that's kind of how I feel most of the time, really. Is that something you go through as well still, or have you worked through that already?
I'm getting better at it, and some of that is kind of just crowd behavior. I kind of, the thing with bull markets is you tend to get you tend to get more diversified in bull markets as well. And that's because, the feedback loops are quicker. You're making money faster. Everybody else is making money faster. Everybody has more cash in their pockets, and things actually react to news for once, and so, there's just that kind of the money churning machine is working. And so, you're always looking at new ideas because you always have cash in your pockets, which means it's very easy to lower your standards, go down quality, in these types of environments, instead of keeping your quality level as high and being disciplined. And I try to watch that even with myself. I do also tend to get more diversified in bull markets because, you just have higher turnover because things are working, things are getting more expensive, maybe too expensive, but always trying to keep the quality level high because it's always easy to go down quality, buy cheap things, and replace the A team with B and C team.
Yeah.
But what I found is, if you're doing this for the long term, you keep replacing A players with B and C players, you're going to win less over the long term. So it's really a balancing act.
That's a tweet right there. If you keep replacing the teams, and we'll definitely get to that point. Do you have an anti-FOMO checklist or something that prevents you from chasing stocks, though, like quantitatively or qualitatively so?
No, I don't really have a checklist. I just tend to look at things through a lens of the price today versus where I think, not what other people think, the business will be in 3 years. Just because the stock's up 200% in a year doesn't mean it's not a buy. So, and you makes it just because something goes down 50% doesn't mean it's a sell. It's like you just have to always see what reality is, do your own due diligence. What is the intrinsic value, and make your choice. And so that's really the only thing I try to do on a consistent basis is not be influenced by anybody else, do my own work, form my own assumptions, and not let the stock price pull me in. I think the other thing where stock prices pull me in, at least historically too, is actually in things I already own. Is actually adding and averaging up too aggressively, because we tend to, as investors, correlate a rising stock price with management execution.
Yeah.
And a stock price that goes down with a management team that's not executing, when those are two independent things. Just because a stock price goes up doesn't mean management's executing. It's easy to think that. And so in the past, I've probably added sometimes too frequently to my current positions, just because, I'm using the rising stock price as an excuse that this management team is executing and I should be averaging into things that are executing. And so it's another area where just to always be anchored to reality, not letting the stock price influence you. But it's hard. But no, I don't have a checklist.
I think that's definitely true in resource, especially pre-revenue resource companies, because a lot of people they love managements who make the money naturally, and so if the stock price is going up, you love the management team, irrespective of whatever their comp may be or whatever history or whatever they've done on the execution level. But so you don't have any hard and fast rules or where you would like sell half on a double, essentially playing with the house's money, or you don't have any of those rules?
Well, it's less hard and fast rules. I think it is partly formulaic, and I think I mentioned this a couple of times already, but like the first part that's formulaic is like where is it today? How much do I think they can earn or produce or what it's worth in 3 years? What's the IR between here and there? And if in bull markets, obviously you're basically pulling forward those expectations, and so, if you have next year's returns or 3 years worth of returns or 4 years worth of returns based on where you believe the company will be at, you're getting those returns today, then it obviously makes sense to take some off or sell the position out completely, depending on, where your expectations are and where reality is. I think the other part is somewhat emotional and psychological, when it comes to position sizing. When a position is running hard, the larger the position becomes, the more it tugs on your emotions. And sometimes you just need to sell a little bit, to sleep at night, as we've heard that analogy before. But, I tend to actually reframe it as when a large position becomes even larger because it's gone up, how much pain am I willing to endure? And for me, and this is going to be a different for everybody, but it might be overly simplistic for a lot of folks, but the right position size for me when a stock is really working and running hard is, okay, can I sustain a 40% drawdown in this stock and it doesn't bother me? And I keep recalibrating to that. I mean, this just happened just this year where it was actually a resource stock. It ran hard, and went up 200% or so. And, I believe in the company. I believe in the exposure it provides my portfolio. But, I wasn't okay if this thing pulled back 40%. And that was, a greater than 0% chance. Let's put it that way. And so kind of that's how I think about it too, is like how much pain am I willing to endure on any pullback? Because anything that goes up fast usually has very sharp volatility that's coming eventually. You just don't know when. I think it's also when it comes to selling, it's a function of opportunity cost. What am I going to replace it with?
Yeah.
As well? And so, for me, I'm not 100% invested in resources. I would say I'm probably 20% invested in resources, and that's primarily in 3 stocks. And I like having that exposure. It has a certain purpose and role in the portfolio, whether that's offensive and defensive. And I'm picky about where I get that exposure. I'm not looking for general exposure where I'm going to own gold bullion or own the major producers. I'm trying to find unique exposure, generally under 100 million market cap, of businesses that I believe are being led by unique individuals that are doing it differently than a vast majority of those types of companies. And so when I sell something, the problem I've faced is, yeah, it's great that I sold this, but what am I replacing it with?
That's
And
yeah.
if there's nothing out there to replace it with, but I generally want this exposure, I generally will sell less. And so that can influence my strategy, when it comes to selling as well. And if you do replace it with something, getting back to our previous conversation about A and B players, like what are you replacing it with? Are you replacing it with something of lesser quality, just because it's cheap? Or are you keeping your quality benchmark as high as that original investment where you've made all this money because it probably is an A player?
Mm-hmm. That's exactly where I wanted to take this, because essentially once you do end up selling something, what do you replace that? What do you rotate that capital in? Because specifically in bull markets, I have a hard time finding cheap stuff. Like everything looks expensive besides what's actually trading at a low market cap, I suppose. And you look at something, it's trading at a 10 million market cap, while a lot of the peers might be trading at 30, 40, or 50. But if it's trading at a low market cap during the bull market, that's probably a good enough signal to stay away from it in the first place. So is it, it could be cheap for a reason, basically. So yeah, how do you buy stuff in a bull market that's good value, but not a value trap?
Well, I mean, I think you're as experienced as anybody. I mean, I think you just need to constantly keep your constantly be looking for ideas, have a net that's out there, because there's always there's always something that probably fits what you want to buy. And I don't, and I hate when I hear investors be like, well, there's nothing out there. Everything's expensive, blah, 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 blah. No, it usually just means you're not looking hard enough, or you're not looking under the surface of the financials enough. There's usually something. And I'm not going to reach and buy things that are mediocre, but I would say one of my strengths or skills as a stock picker is having a very broad net to where, it's like a spider building a web. And, yours too, Antonio, where you have a great network of investors and a platform here.
Yeah.
You have that spider that builds its net, and you can feel when something hits it and there's a tremor, and people know what you're looking for and what you like, and so the ideas are just as much other people showing you things as you going out and finding them.
Yeah.
And I think that's ultimately where successful stock pickers find themselves, is a lot of the ideas come to them. They don't necessarily have to go find them anymore because people see value in Antonio owning these companies or Ian owning these companies. And that's kind of the cool part about stock picking, as you kind of mature and get better at it, is people want you involved.
Well, I hope I eventually get at that point. I don't think I'm there now, but it's at the same time, when I find something that does, and I do talk to a lot of companies, I go to a lot of these conferences, meet a lot of people. But when I find something that hits my net and it seems like I'm going to like it, if I look at the stock price, it goes back to what you were just saying, and it's up 150%. I'm like, oh, I missed it. Like, it happened this year multiple times where someone's like, oh, look into this. I start looking into it, and by the time I'm done with kind of following along or researching it, maybe they've had a news release and the stock has gone up, and I'm like, oh, I missed it. It went from 20 cents to 30 cents, 50%, I missed it. And then it ends up going to $1. And I'm like, it was obvious. I should have bought it. Hindsight is 2020. So that's also part of what I don't really know how to deal with. Like, how do I buy something?
It's funny you mentioned that, because I think the longer you do this, the quicker you can get. And I found that too with myself. Like, it's always cerebral to say that, I do exhaustive due diligence and I spend, 4,000 hours doing this and doing a site visit and doing that and this. But the real answer is, like, the more you invest, the more you find out what you're looking for, the quicker you can make decisions. And it's more about, okay, these are like the 5 core things that I look for. And you can kind of check through them sometimes within minutes, and you're like, this is interesting enough to add a 1% exposure into the portfolio with this. And I'll dive in later, not later, but, over time. And that's what I've found, with my own investing, is like, I can pull the trigger really quick because I know what I'm looking for. And I think the longer you invest, the more you know what you're looking for. And you're still, I own, I think it's a company I mentioned on your podcast before, like Idaho Strategic. I've been in that thing for 12 years, and I'm still learning about it, and I still probably spend an hour or two per week, learning about kind of their properties, whether it's critical minerals, whatever it is. Like, I'm still 12 years later, going under the weeds and learning about the thing that I've owned now for 12 years. So it doesn't ever stop, but I think that initial kind of spidey sense, it triggers and it goes off. I've been quick to add things quicker than I probably 5 or 10 years ago, because I feel like I'm getting better at those broad strokes. And it's usually what's important, and also I don't let the fact that it's up 50% in the last month or 100% stop me. It's all about, where do I think it's going to be in 3 years, not where it's going to be next quarter. And it's, as we talked about before in previous podcasts, I'm generally, especially in the commodities space, I'm looking for unique management teams that have revenue and earnings that I don't think will dilute me, over a longer period of time. And that in itself is a very rare thing.
Yep.
And obviously trying to find that in sub 100 million market cap, so small producers, that, hopefully didn't do any bad toxic debt or streaming contracts or offtake agreements, that are run by people that own 10% plus of the businesses, that hate dilution.
That's actually maybe a bit off topic here, but it sounds to me like so speed matters to you as well. I suppose speed does matter in bull markets specifically. Would you? It's only half off topic, I guess, and we'll get back to topic. But would you use AI in the process, like I don't know, Chat GPT, whatever, to run something quickly? Because I feel like that's coming up, but the quality of the takes that I see online that you can quickly recognize when it's Chat GPT or not. They've gone down in quality. A number of them has gone up, like in quantity, but in quality they've gone down. So is that something you use personally?
I use AI for some of the deep research. I find Gemini and the deep research there to be really good. It gets me up to speed fairly quickly. It gets you like 60% of the way,
Mm-hmm.
when you're looking at something new. Um, I also have started using it as a screen. There's some different technologies that you can use that are out there specifically for stock selection, where, they allow you to do some generative AI search across all transcripts under a certain market cap and sector, and, what inflected on profitability, or a management team that mentioned transition, or you can pull out keywords where it just kind of, you can pull out things that are in transition or transformation, just simply by doing kind of an AI generative search across transcripts and press releases and things like that. So I think there's certain tools, and some of that is AI driven, some of it is just better screening tools, that is making it easier to find some of these. So the answer is yes.
Yeah. Uh, it sounds to me though that it's sort of like what they say is kind of like human AI human, whereas like for a lot of the stuff that I see online, it's like human AI decision, where it's like they ask a question, AI says something, they make a decision based off of that. Whereas like with you, it sounds like you're using it as a tool in the meantime, but like the beginning and the ending of it all, of the decision process is still up to you. That's
It is. And it's like, and I do believe that because of the influx of AI tools and everything, I think that will be commoditized to a certain extent. And I do think the real value will become, as it always has been, but I think it might even multiply in importance, is the one-on-one interaction, site visits, going to meet management teams, things of that nature. I think will become an even more important differentiator, because something that the AI or tools can't even pick up on.
yeah,
So I think it's important at least for my strategy too, to continue to do that, because that's really where you get the differential insights at that point, when everybody can screen anything for whatever they want. Anybody can go into these tools now and be like, what CEO under 50 million market cap and resources even mentions no dilution in their earnings call. It's probably, it's just like little triggers like that where you can find that everybody can do that now,
yeah,
so, but not everybody's willing to get on a plane and go across the globe like you did to the Yukon or wherever you're going, and actually meet with management teams, where they'll probably tell you, and you'll learn a lot more about their business and their strategy.
yeah. A year ago, I would have probably disagreed that site visits are that much of a game changer, but they completely are. Just even spending a couple of hours with the CEO, just driving up to site is already worth the
Mm.
whole, was for me worth the whole trip. So that's a great point. I
And
think,
it's that time, it's that time. It's just like any interview too. It's the key is like spending 2+ hours, because you can put on a sales face for an hour,
yeah,
but after 2 hours, like you get to see who they really are, to some extent. They've kind of went through all of their usual sales spiel by then, and you get down to who they really are. So I think, if you can spend 2+ hours in person with a management team, you're going to learn something.
yeah, that's actually an underrated point right there. I decline interviews with people who are like, I can give you 15 or 20 minutes, even 30 minutes. Like for me, it's at least an hour, even on update interviews for that specific reason. A lot of them are just trained salespeople. And when you go to a
Mm.
conference, the meeting is a half an hour. The presentation is 15 minutes. That's what they're trained to have kind of all their blockades in, and they're trained on no pushback. So yeah, that's also that's actually a very underrated point. Kind of listening to people for longer than 30 minutes, or even longer than an hour. What do you do though if you end up buying something that is underperforming or something that looks cheap, how long do you give it after that? How long do you typically give it to stop underperforming essentially before moving on? But again, also making sure that you're not selling too early.
Well, again, it gets back to, I think, having a view on where that business will be in a year or two. And some of that will be based on what management says. And I tend to have a short leash with management teams that don't do what they say, with a little bit of wiggle room in there because the world doesn't always go the way we want it most of the time. Um, but I tend to really have a 1 to 3 year view on expectations on what that business will do and give them a little wiggle room to be in error and a lot of room to exceed my expectations. And I think a lot of the problems we face too is we get into things and all of a sudden our portfolio is a whole bunch of, I call them wait another quarter stocks, where you're always just wait another quarter, wait another quarter. You thought the catalyst or event or inflection or acceleration was happening. You're like, well, let's wait another quarter. And all of a sudden it's 2 years later, and nothing's happened. It's probably a good definition of most micro caps right there. So it's important. It's important to be in the ones that are executing. And the ones that are executing are sort of obvious. It's not just the stock price going up and to the right. I mean, they just put up results and they make it look easy. The ones that don't execute always make it look hard, and they always have excuses, and so if you can just be in the ones that actually put up the numbers that make it look easy, that's what I try to do. And I wish I had 20 of them in the portfolio today, but the game plan is to get as many of those in the portfolio and as many of the ones making excuses out.
That's something I think I've read you say recently as well, is that the good teams generate excuses and good teams, bad teams generate excuses and good teams generate results, or something along those lines. It's actually something I want to talk about later on. Do you think that applies to pre-revenue? I know that's not something you do a lot of, but like exploration, mineral exploration, because I feel like if you have a thesis for a mineral deposit, the company drills it, it's not there. 9 out of 10, probably 9.5 out of 10, they're going to tell you, oh, we missed this time, but we have this geological data. So next time we're going to hit it. And they kind of keep you waiting for that next time and next time and next time and next time. And rightfully so. Like a lot of the big deposits were discovered after 100, 200 drill holes, or whatever it might be. But does that really work for, small retail investors or just retail investors in general? Does that work in mineral exploration as well?
I think it can. I mean, I think it's the same, somewhat similar. I'm invested in one, I would call it almost a pure exploration company. And they did a financing round, and the largest holder, the founder of it, did 20% of it. Again, it kind of gets back to the people. What attracts me to anything, regardless of whether it's resources or non-resources, is the people involved. Do they have past success? And I love to see success not only in that industry, but other industries. And that usually means they have a personal net worth. They can backstop any type of financing moving forward. And it's probably going to be on favorable terms because they don't want to dilute themselves into oblivion with a really bad deal. So that's usually what makes my spidey sense go off about any company, not just resources, is you have these people that have a history of success for some reason being involved with this small, obscure, company. And that's what attracted me to this specific company, which I won't mention. It'll probably go to zero if I mention it, so I'm not going to. But they outlined a very detailed plan for the next 12 months on permitting, on PEA, all these things. And for me, it's just like, okay, obviously things can shift and happen, but, are you going to hit it on the timelines that you said, because you raised a certain amount of money to get a certain amount of things done, which hopefully will unlock value and the stock goes higher, the usual exploration game. And they have. I mean, everything they've done probably within a week or two of when they originally put it in that investor presentation. And it just gives you more confidence that the next time they want to raise money and outline what it's going to be used for and how it's going to unlock value, you believe them more, because they've done it before and they do what they say and they say what they do. And obviously that's not a very detailed answer to your question, But I do think that there are some of these principles that could be applied to pre-revenue companies.
This is actually, believe it or not, it's an unpopular opinion in a lot of the chat boards online, because essentially what you're saying here is winners win, and put your money with winners across different industries. And funnily enough, that's almost an unpopular opinion in a lot of these chat boards. But again, how many stocks do you typically own during a bull versus a bear market? Does that differ?
I do tend to get, and it's hard to get away. I do tend to get a little bit more concentrated during bear markets,
Hmm.
and then a little bit more diversified in bull markets. And for me, I mean, I manage a fund now. We have about 35 million under management, and so that would be different with this type of asset base versus if it was, just me personally. I also have a higher concentration level, risk tolerance, I should say it that way, or volatility tolerance than, investing for others. But in our fund, it's still concentrated. We're in about 15 companies,
Hmm. Okay.
so it's still relatively concentrated. A bulk of, I would say, the top five make up 60%, 60, so it's very top heavy. And what I like about that is, most of those top five are companies that have gone up a lot. They've earned the right to that position size. They aren't ones where I constantly am buying more and increasing my at cost capital into those positions, trying to prove to the market that I'm right. Um, and so that's where I've evolved, I think, over the last 10 years too, is I've always been I have no problems holding 20% positions, but I would be more willing to make a 20% bet on something instead of making a 3 to 5% at cost position, letting it run to 20%. That is a much better way to concentrate because they've already proven themselves, the positions. They've earned that right to a higher position size. And because you bought it correctly with a smaller at cost position, you're able to live through that volatility better, because you're already sitting on a nice gain. It just allows you to hold, I believe, that concentrated bet much easier when you sized it appropriately in the beginning.
Do you have limits though? Something like no more than 20% saying one specific name during a bull market. Like, if it runs from, you take a 10% position, but then it does really well, goes to a 20% overall position, then you're like, okay, you got to start trimming sort of, who said, yeah, trimming your flowers essentially, and not whacking the weeds, or is that not something you do?
Usually the spidey sense for me, is usually around that 25% kind of mark, what I found. Um, but even then, I'm always, okay, where's this business at today? And where's it going to be in 3 years? If this management team is executing, one of those rare groups of management teams that do what they say what they do, they exceed expectations. You also don't want to sell quickly. You want to sell slowly. And I think that's one of the things I've learned too over the last decade or two is when it comes to selling winners, don't sell out of all of them. Don't sell out of your entire position. It's okay. I think when I was younger, it was like, no, this is either a 20% position or nothing. It's like there's no half convictions or I'm not I can't sell this down to a 8%. What's the point of that? And that's where I've evolved to is like, no, it's okay to trim something from 20 down to 10. And just letting it run back up to 20 again. That's how the greats do it. So that's where I've gotten better with it. It's just making sure I don't sell out completely of the ones that are winning, just because they tend to keep winning. And then you look back and you're like, well, I was an idiot for selling out of it. Well, you didn't have to sell out of all of it. Even if it was a little bit expensive, just hold on to some of it. Yeah. If you hold on to some of it too, it kind of gives you the mental freedom to buy more of it later too, because you never did sell out of all of it. So it's kind of like a brain trick a little bit too.
Well, I feel seen specifically with that part where it's like kind of all or nothing. Tell me more about that. How did you, when it kind of, when did the light switch flip for you? When did you figure out like, okay, that's not how I should be doing it?
I mean, it was just after seeing more and more examples of things that I completely sold out of because they went up really far and too high, I thought. And then watching them continue to go up, and yes, they had volatility. Maybe they pulled back to 40%, kind of that threshold we talked about before. But then they kept running. The management teams kept executing. They backfilled, the management team backfilled into the valuation that I thought was too expensive quicker than I thought. And then it just kept on going up. And so it just was kind of common sense not to sell out of management teams that have a history of executing completely.
Yeah. Do you keep larger cash positions than normally during bull markets?
You tend to have, because of the higher turnover, you tend to get access to cash quicker. So you might not be sitting on a cash position, but you might always be selling something and always be buying something. So you can kind of get to cash a little bit easier. And the nice thing about bull markets too is most of these stocks are more liquid now than in bear markets, that's for sure. Yeah. But when it comes to cash position, I usually always don't hold too much cash. I just tend to be pretty close to fully invested, give or take maybe 4% cash position, something like that. I usually like to have enough cash where I can buy almost a full position in something new. And then if I really want to buy more of it, or if I have two new ideas, it forces me to sell my least convicted idea. And so I'm always trying to getting the batting average up on the portfolio. I'm not going to add a 280 hitter to a group of 300 hitters, to use a baseball analogy. It lowers the average. I wouldn't do that. Just always so I'm always trying to think and view what is my least convicted position. And that's usually where the capital is going to come from to buy something new that I think has a higher IRR than that one.
So you don't necessarily, okay, that makes sense. Because I thought actually that during bull markets, I thought more or less the same. So during bull markets, you keep less cash because cash is more easily available. And there's also fewer opportunities by definition, I suppose, in bull markets. And then during bear markets, you might keep a little bit more. That's kind of how I've been thinking about it. I'm actually not even that far up the learning curve where I can even have a cash strategy in the first. Like most of the times, it's not. I don't have a cash strategy. I have more of a portfolio strategy, and my cash is as a result of the portfolio strategy. If that makes sense.
No, I think that's how I view it too. I think it's a good way to put it.
Okay.
It's like I let the portfolio determine my cash position.
Yeah. Yeah. Yeah, that makes sense. What percentage of the fund that you said? So you manage 35 million now. What percentage of that is in resources now?
Probably about 20%.
Yeah. Is that going to go up or down thematically? I mean, is this what seems to be a bull market? Is that develops either goes up or down from here? Is that going to change?
It has gone up because the underlying companies that make that exposure have gone up. But also, as you can tell, like it's not just a bull market in commodities. It feels like it's a bull market almost in everything lately. Every government across the world is trying to have a race to zero with fiat. So it's just propelling, every price higher. That's what we're seeing. So I've had other things in the portfolio work too. But yeah, the exposure I have to resources has done fairly well. And I'm interested. I find myself, the older I get, to be a slightly more contrarian looking at these sectors too that are out of favor, just like gold stocks were, and obviously arguably they still are, but how that was 2-3 years ago, now like the most hated sector in the world is oil and gas. It's like the most underexposed area to institutions, and so I find myself kind of looking at these unloved areas or sectors similar to how I looked at gold in particular, going back 10 years and trying to find the great operators running companies within that hated sector and making potentially a couple small bets on them now and following them, knowing that at some point, that sector is probably going to get more in favor, maybe not loved, but less hated, at some point in time.
I think it's that's psychologically that's probably very hard because kind of as a natural resource investor, like you mentioned at the beginning, sometimes you're waiting 10 years for something, a market as a whole to work out. And then once it starts working out and your gold and silver stocks are going up, it's really hard to be like, okay, this nice, fuzzy, warm feeling that it is, I'm just going to, put an axe to it completely. And I'm going to go in something that's really hated and wait over there.
Yeah.
I think that's really tough.
Well, and I think the answer is the same answer we just talked about with individual stocks. You're not just because I'm looking at another sector doesn't mean I'm selling out of gold or resources, but the other resource portfolio just means you're dipping your toe in the water with a single digit, maybe small single digit percentage of the portfolio in a new area.
Yeah.
You might keep the resource portion exactly the same. You're just kind of looking at the fun part is in every hated industry, you can find two or three small companies that are bucking the trend of that contraction in that industry that for some reason they're making money, even at a low commodities price or whatever it is, and um, that's what makes it fun. And usually at that point, you're getting them at single digit PE multiples, because nobody cares. And yet you position size it's so small because you just don't know how long you're gonna have to wait, but you kind of get to know it, get to know the management teams, whether it's over 1 year or 5 years. So it doesn't really matter.
Yeah, I think and I keep on saying I think because that's not really how I have approached everything so far this time around. Meaning this is more of a top-down conversation where you're paying attention to what
Mm-hmm.
metal's going up, for example, or what part of the commodity segment is going up, and then you switch your portfolio to reflect that. What I do is kind of start at the asset level, so start bottom up, and I pay less attention unless everything is going up, kind of like what's going on right now. I pay less attention to the underlying metals, like because I want to have the essentially I want to do this full time, and I want to have the ability to make money in bear markets as well. And the only way you do
Yep.
that is bottom up, right? In bear markets at least. You write though in another one of your articles. You write, I think it was the one prior to the one that we just discussed. You say that the most important question is how long will it last? So let me ask you that question: how long will this bull market in everything, but also in mining? How long is that going to last, and when's going to be the right time to again maybe start trimming some of those positions?
Well, and some of this was mainly that topic was probably mainly geared to non-resource, but I guess it could be relevant to resources as well. Is a lot of these smaller companies, they have a season of winning. They get, and these are small businesses, so they get a large contract or they get a large order or whatever the case may be, and all of a sudden they show 30 or 50% growth out of nowhere. They go from breaking even or slightly unprofitable to making money. And, it kind of transcends their business up into the right. At the same time, it happens so quickly. They're not backfilling with processes and talent to support this growth. So they're over earning. I mean, they're showing a bigger bottom line than if they're making by the long term hiring and the new ERP systems they need to put in place. So you have like 2 or 3 quarters where revenue's going up to the right. They're over earning. They're making a lot of money. The stocks rip because investors that are looking at it, they annualize whatever the last quarter was and say, this is going to go up in this trajectory till infinity.
Yeah.
And really, it was just a 3 or 4 quarter spurt, and so you have, I would say 70% of microcap wins are that, where you have this spurt of winning due to a large order or large event, one-time event that's not sustainable. And the stock goes up 100 to 300%. And then they eventually stub their toe or they put up a bad earnings report, not necessarily bad, but they finally make the investments they should have made 2 quarters prior. The bottom line actually goes down, even though the revenue is still accelerating. It scares out investors because the income came down and the stock, drops 50%. And then some of them, backfill and are able to grow their way out and then reach new 52-week highs eventually, but most of them don't. They just don't have the talent or product line to take it to another level or even keep it at that level where they just had it for 3 or 4 quarters. And so it's important for, I think, all microcap investors to live in that reality that most small businesses, and again, kind of this is more of a non-resource conversation. A lot of these small micro caps that are non-resource that are growing profitable, they can have that acceleration for a short period of time. They have a shorter shelf life than what you usually think when you're looking at it. And to always have a finger on the trigger finger. And again, it gets back to always knowing what you own, knowing the management teams, knowing the business. And a big part of that is, yes, being able to hold when you have a multi-bagger. You can't have a multi-bagger unless you hold one, but also understanding that you want to keep that gain too. And the reason you stay on top of your investments is so that you can sell before others sell.
Hmm.
When you see the sign of the investment thesis cracking or see the world changing. So that's a rambling answer, but that was the basis of that article and several articles I've written on shelf life, on conviction investing. And a lot of that's just to counterbalance a lot of the narrative we see recently over the last few years, just on coffee can investing, buy and hold forever, that type of mindset, insert philosophical quote or stoicism, to kind of counterbalance that a little bit, is to make sure you can do that, but it's really hard to do that in micro caps because these are small, emerging, fragile businesses that are filled with concentration risk, key man risk at the top, customer concentration in the middle. There's just a lot of risk there. And so just live in reality, just like how we started this conversation, not what you want the world to be.
Well, to that point, specifically the key man risk at the top, I think that ties nicely into one of your very recent tweets that says, quote, the best investor relations is insider buying, unquote. There's a whole tweet. That's kind of like a mic drop moment. It's like, that's it. That's the tweet. I like that a lot because I think one of the main issues with, it's probably a big thing in across the micro cap space, but it's definitely apparent in the resource space, is that insiders act too much like they're temporary employees, really, not enough as owners. And so I always ask questions around that in my interviews with CEOs. And I always ask, like, well, if you think your company is undervalued right now relative to peers and it's a bull market and everything, why aren't you buying? And it oftentimes comes down to two things, two excuses, really. They're either blacked out because of news flow, they've got assays results coming in or whatever it might be, or it comes down to sort of their personal situation and risk profile, not allowing for additional exposure to what is it's a high risk, high volatility sector. And on the topic of bull markets, the latter one becomes even more so a challenge as their positions have already grown as a percentage of their net worth due to the bull market. And they probably actually want less exposure of their kind of overall life to the resource space instead of buying more. But, and I'm sorry for yapping on so long, but I'm about to shut up. But that actually leads me to an earlier tweet of yours that you had just before that. And it said, quote, great companies will always make it look easy. Mediocre companies will always make excuses. So what is, let's call it conviction sized insider buying in micro caps in your book? And again, specifically during bull markets, what's that size?
We could talk about this for a long time. I think the main genesis of why I tweeted that about investor relations being the best insider buying is just like you talk to a lot of management teams and they're wondering if they should or what they should be doing for investor relations. And, some of them, as you know, are spending hundreds of thousands of dollars a year on getting the word out in their stories, probably equivalent to what they're spending drilling holes in the ground. And I've countless times I've talked to some management teams and I just said, if you just bought $5,000 of stock a month, as a CEO, that's probably the best investor relations spend you could do.
Yeah.
And yeah, it's $5,000, but that it's not just seen that you buy, it also attracts the quality investor that you want to attract. Because, real investors are drawn to that, when they see skin in the game. And I don't know if there's necessarily a dollar value. I mean, obviously we all like to see, more, and we all want our management teams to own 30% of the company, make nothing, and buy stock every day. That's kind of like that's what we would love to see. That's also not reality. But I tend to focus that tweet on those that do overly spend on investor relations. And I just think it's unnecessary if they would just spend a little bit on, putting their money where their mouth is and putting some skin in the game on a consistent basis.
Yeah. It's essentially what percentage of your skin is in the game that I find more important. Especially with resources, there's always the cheap paper, not always, but oftentimes there's the cheap paper that we deal with. An insider might own 30%, but they might have raised, 10 million bucks up until that point, and he's only provided like 1% of the capital, but he ends up owning 30% of the company. Is that really skin in the game? Is that 30% skin in the game? Not always. Sometimes it can be, because that 1% of the company might be, his entire net worth at that point, because they're just starting up a company, very entrepreneurial, whatever it might be. So it's all very subjective.
It is.
Yeah.
It is. I mean, it's very subjective. There's no hard and fast rules to it, but it's never a bad thing when you see management teams buy. And it's usually never a bad thing when you see them sell either. That's what I find. The counter to that, a lot of times, I mean, it's easy to forget that, most micro cap management teams, most of them aren't rich either, so, when and if they do sell, it's like, yeah, they have kids in college, they have, future lake houses they want to buy, that they want to spend time with their grandkids at, and they need to get that money from somewhere, and I've evolved there too, where not every time I see an insider sale, it's he has lost conviction in the company, or he thinks it's overvalued. You kind of put yourself in their shoes as well, where you just have life expenses too, and that happens as well. So I've seen it cut both ways, but on the insider buying thing, it's mainly geared towards companies that overspend on investor relations when they could spend 10% of it and just buy their own stock and send a clearer message.
Is open market buying better than participating in private placements, though? And would that be different during bull markets than it is in bear markets?
I think it's about the same. Whenever they're putting real cash into something, like you said, not given shares.
Yeah. Yeah. Well, and that's actually a good point, because those are discretionary buys, right, that you're referring to. So not accounting for like automatic insider plans and options, RSUs, and so on. So, or do you count that as well?
I mean, if it's real money going in, I count it. Real cash, their cash.
I think it can be misleading as well, in that it could also be orchestrated optics, charades, essentially, before financing or before something else happens. How do you tell that how do you tell real insider buying apart from insider buying that's only intended as marketing? Because the way you put it in the tweet is not like, instead of spending on marketing, spend money on your own stock as marketing. It's more like show your conviction type of thing. So spend money or invest money in showing your conviction, not so much as marketing. But sometimes, especially in the resource space, it is orchestrated marketing. So how do you tell, real insider conviction from charade based on the buying?
I mean, the type of buying that I like to see is smart buying too. Maybe not automatic buying. Usually the type of buying I like to see not necessarily is on the way up. It's maybe putting in the floor, on something, where the stock hasn't moved, or maybe it's even gone down, and it is a statement that they're making that they believe that this company is undervalued. And yeah, you're always going to have these outlier events where, the guy makes $1 million a year and he buys $2,000 a month. Like, who cares? You're always going to have these types of things. And I think it's easy to see that and weed that out, but I also think it's not too hard to see what genuine buying looks like.
Yeah. Yeah. And sometimes it gets so very sad in the resource space that some of these buys are like just doubled. They're like $99 or something like that. And then that's when you start thinking like, oh, maybe because on the SEDI filings, it just shows up as green on top of each other, and kind of, it's good for the optics, but sometimes it's like, it could be $300 or something like that. And
no, I've seen that before too. It makes me chuckle. You see like $100 buy every month or something.
Yeah. It's like, oh yeah, I'm putting my money where my mouth is. And then you check, the bonus for last year, and the bonus was like, $800,000, something like that.
Exactly.
Yeah. Well, to the point of what I just said, like, is it better or asked, is it better to put money in the open market or better to put money in financings? Financings or private placements are different during bull markets as well because it's typically, or well, hopefully, there's more demand. So, do you think it's absolutely necessary for insiders to also participate in the financings when they're done during bull markets?
I think it's always good to see them participate a little. We just did a finance, we led a funding for a company, not a resource company recently. And I told the CEO the same thing. I was like, you should at least do like 5 grand. It's like you don't have to put a lot in, but I think I don't know, it just sets the tone that at least management participated. Um, it's just something that I like to see. And this person doesn't have a lot to put in anyway. It doesn't have a high net worth. So, I'm always a fan of the management team doing a little bit of every round.
Yeah. Yeah, I'm asking that again within the framework of
I think
excuses.
it comes back to just leading by example. Like you just want to see that.
That's fair.
It's smaller, big ways.
Yeah. It goes back to those excuses because sometimes I would hear, oh, it's a bull market. We have so much demand for the financing that insiders don't want to unnecessarily dilute shareholders by, taking a chunk of the financing itself. And that's always kind of like it's an explanation, but most of the times I'm like, does that really make sense? And most of the times it doesn't, at least in my opinion.
Correct. You're right.
Yeah. Well, on that topic of dilution, do you have lower tolerance for dilution and bad financings in bull markets? And again, looking maybe from for tangible rules where you say, for example, the company shouldn't be issuing more than 10% of its market cap, or they shouldn't be doing warrants if they're a good operator, because again, the bull market would have taken care of a lot of that upside, so you don't have to issue a larger percentage of your market cap that you normally would, or something along those lines.
I mean, I'm always cognizant of dilution. I mean, it might not be a good question to ask me because I don't invest in too many just pure pre-revenue kind of resource companies. I mean, for me, the dilution is always an IRR question. Like, what are we getting for this dilution? We're getting more earnings per share, for this than the dilution is. It's like, is it going to be accretive or not? And I would hope that all the management teams that I'm invested in think of every equity raise, if they do one, through that lens of, is this accretive after the raise on a per share basis? Are we going to be making more money per share than before this?
Yeah.
Maybe not immediately, but in a couple of years, whether it's for an acquisition or whatever the case may be, why they're raising the money.
Well, for that, yes, I think I typically like working with ratios for exploration companies. I do whenever I'm interviewing a company, I kick it off with two ratios. One of it is the exploration to administration ratio, I call it. So I look at how much money is going into the ground versus how much money goes into running the head office. And then I also do a ratio of drilling to marketing. And essentially, I want to see that, substantially more money is going toward drilling and assaying as it is going toward marketing. And I obviously have my preferences, but I wonder if those numbers should be different during bull markets. Like could marketing be more accretive than drilling during bull markets? Actually, unfortunately, some of the times it can. So, I mean, do you prefer your holdings to increase marketing spend during bull markets, or where do you see the most accretive spend being essentially?
I see the most accretive spend is when they have, I wouldn't say an overpriced equity, but they have a fair valuation on their equity and they can buy cheap assets, ones that they can add value to. That's how I would view it. And probably also on the resources side as well.
Yeah. Yeah. I think that's a good point, about, because marketing is not, with marketing, you're not buying an asset unless you think you could, raise the stock price and then issue new shares. But what you're doing at that point is pissing off all the new shareholders. And that, like the whole idea of, we're going to raise our stock price, then we're going to raise it, and we're going to buy an asset, and we're going to kind of do, 5 steps forward, 1 step back, and then 5 steps forward. That rarely works out. Like, it sounds like it should work in theory, but most of the times, like 5 steps forward and then, 50% down, which is, it kind of puts you at ground zero.
It's hard with pre-revenue too. It's like, I'm talking mainly about production assets or, things like that you actually have a quantifiable, cash flow component to it at some point in the near term. It's obviously it's more difficult to assess dilution on revenue or just pure exploration companies, because you also, it's not only like the capital you're raising, it's like, that stock's going to be freed up in 4 months or 6 months. You have to eat through that paper at some point to get
Hmm.
somewhere. You better have enough positive momentum with the business and not just promotion on the stock to eat through that so you can actually get to a new high.
That exactly. That's very well said. That's definitely applicable to resources, in my opinion, and pre-revenue as well. I know you almost have to go though here, Ian, and so switching gears a little bit. And that last question that I want to ask here is maybe a podcast in and of itself, but kind of leading into the point of marketing, I suppose, is I always say in my disclaimers that everything you see online from an issuer themselves or an issuer adjacent figure like a Twitter account that is either close to the issuer or paid by the issuer in some shape or form, all of that, everything that these, and especially the pre-revenue ones, everything that these companies do is intended as marketing. They're out there, like the presentation, the website, the news release, the Twitter account, everything is kind of, it's not kind of, it is marketing. And so come bull markets, what I really don't like about bull markets is that everyone's a genius again, right? So even the guys online who are in the business of selling opinions and tend to underperform massively over long periods of time because they don't have their own opinions. They just like whoever pays them to like them. They also make money, even though in bull markets, right? Even though the making money part is mostly uncorrelated with their opinions, if that makes sense, because again, their opinions are marketing, and essentially, therefore, should be treated as noise. And it's the amount of noise specifically in bull markets that makes it hard for me to know what to read and what to skip and who to pay attention to. How do you deal with that? What's your information diet, if you will, regarding public opinions and noise during bull markets?
I tend to filter most things out, and you're right. I mean, in bull markets, it's just the constant rise of inexperienced people educating other inexperienced people, and in bear markets, the losses do the educating, and I just think over time, just like I'm sure you are too, you start to just form a close network of people that you view as signal, not noise. And it just takes time to figure out who those people are in your life or your area of investing, and then you're just getting really good at just screening out everybody else that's just, making noise. But you're right. I mean, you see it not only in resources, but everywhere right now. It's a little bit too easy to make money right now, which is a little bit scary because you can kind of sense it, but as it relates to resources, I mean, the federal government, at least our federal government here in the US, is making it hard for gold to even have a pullback. So they're making their intentions known. So it's an interesting time to say the least. I mean, I think the interesting thing about kind of resources too, compared to 20 years ago when I first kind of started dabbling in it, is I think the advocates in resources back then were mainly just doom and gloomers.
Yeah.
And there was this just kind of negativity about the space. And yeah, to your point, like they didn't really make money on any of their beliefs of anything going low to high. I mean, they made money on speeches and newsletters, and I think where it's changed, that I've enjoyed to see this change, is, there tends to be more of positivity around it, which I think is important. It's always bugged me back then. And you're starting to see it now. It's like, yeah, we don't need the world to end to make money in resources. It's like the world can get better and we actually make money. You kind of need that for copper or whatever type of thing you're trying to play. Right. So I'm glad to see kind of an increase of positivity kind of enter the resources space. And I think now is an interesting time too in resources, because unlike in 2007 or 8, when you're dealing with $120 oil and input costs were going up just as much as the commodity or price that you're investing in, now like these producers or, emerging producers are just making a lot of money because those input costs are still low at $60 oil, and so you're having this interesting time period where companies are making a boatload of money right now. Gold producers are doing fairly well because the input costs aren't rising as quickly as they were in other bull cycles. And you're starting to obviously see a lot of significant cash generated. And your previous guest mentioned, how most of those large producers globally, are putting 8 times as much money into buybacks and dividends as they are in exploration. And so a lot of these large companies just aren't exploring that much. And guess what? That means they're going to have to partner or acquire, in the junior space. which is making it exciting for juniors, and we haven't seen that influx quite yet. And there's going to be a lag there. But I think it's an interesting time right now in resources where, the producers are making a lot of money. It still takes 5 years to put anything into production. So you probably have another 2 or 3 years where, it shouldn't be too bad. And so it's an interesting time to be out there and be a stock picker, whether it's in resources or non-resources.
Yeah. That's Neil Adshead that I believe you're talking about. That in that interview, that was actually a very good interview. Well, he delivered a very good interview, I think, in my opinion. But you make a very good point. I actually been there, done that, where it's like it's actually the negativity that got me into this space, I think, in the first place. Part of it is media too. So it goes back to what's noise and what's not. Negativity gets a lot more attention than positivity. So, oh, the world's going to burn, therefore gold's going to go to 10,000. I've spoken to all these people and like at a certain point it starts clicking like I think it's OBS. I think by far in the most, the most money has been made in resources from the world getting better and not worse, industrial revolutions and the China cycle and whatnot. And not, things crashing and burning and it being the end of the economy as we know it and stuff like that. Because it's always the end of the economy as we know it. The economy is always changing. It's a long topic. Again, I said we could probably make a whole podcast on that as well. It's that noise is increasing though. And I think it's a good point to, understand that the vast majority of people don't actually make their money in the market. And so to deal with and figure out what's noise and what's not noise, ask yourself, where does this person make their money and what's the history of them actually making their money? Is it in the market? Is it by selling services? There's nothing wrong with selling services inherently, but if they're claiming that they make their money in the market, but they make money from selling services, that's kind of a problem. Yeah, that's kind of my summary on that one there. I'll let you go. I know you have your own life, apparently outside of picking microcaps. What else do you have coming up? You've got an event coming up in October in Toronto. What else do you have going on?
That's the next thing. Yeah, we have an event in Toronto. I think it's October 21st to the 23rd. I'm not going to call it a non-resource conference. I think we'll have around 70 companies. I think we have 5 or 6 resource companies. We might have a few more by the time the event comes around. But this is our inaugural event in Toronto. It'll be a 2.5-day event. First day is speakers. Second day will be company presentations all day. Third day are one-on-ones all day. So that's kind of the genesis of it. We have over 300 investors signed up already, which is pretty incredible. And yeah, if you're into microcap investing, like meeting emerging companies, come out and say hi. That's where I'll be.
Who do I have to beg to get in?
You can go to Planet Microcap. If you just search Planet Microcap Toronto in Google, you'll find the link and URL to it. Or if you go to microcapclub.com and click events on the header, it'll take you right to the registration page.
You guys just had one not just, but this year you had one in Las Vegas, if I'm not mistaken.
Yeah, we had one in Las Vegas in April. That was incredible. I kind of viewed that as kind of the main event. We had, I think, 600 investors there. Yeah. About 1,200 attendees, and where it's a little bit different too is like there's no charge to come as an investor, but we do have somewhat of a screening process to where we don't want hooligans showing up either. So we just want genuine investors that are there, for genuine purpose of investing.
So how do you make money on this? Oh, it's issuer supported, or how does that work?
Yeah, it's issuer supported, sponsor supported. And it works out well for our community of Microcap Club partnering with Planet Microcap, just because it provides a venue for our community to attend in person. And so we carve out a few different events inside that event just for Microcap Club community. And so it's been good to work with them because they're happy to carve that out, because most events, and same with resources too, most events in Microcap or resources, yeah, there's 1,000 people there, but there's like 30 real investors there. Everybody's there just trying to sell you something, And so at our events, we focus on the investor. So like I said, when we have 1,000 people at our event and 600 of them are actually investors, and we're filling up one-on-one schedules with good companies, that's the key. And that's the flywheel of any great conferences. Keep the quality level high of the companies. That attracts quality investors. and that gets them coming back next year. And so keep the quality level high across the board.
Well, I see it on here. It's October 21 to 23, and it is, yeah, you can go to, you can just, that's what I Googled, Planet Microcap Toronto. It's the first thing that popped up. So,
Yep.
yeah, awesome. Well, thank you so much for doing this, Ian. Let's, last time we spoke was like over a year ago, like maybe a year and a half. Let's maybe not have it be 18 months when the next time we talk, but I really do
Agreed.
appreciate your time.
No, thanks for having me on.